As the saying goes, during the times of change, some construct barriers while others erect wind turbines. This sets the stage for today's fifth session, which focuses on the topic of international taxation and taxation on online gaming. We are delighted to welcome Daksha Baxi, founder SRI Solutions, with us to take on this topic. Daksha has 35 plus years of experience in international tax advising, focusing on legal strategies. She's an expert in cross-border M&A treaties and domestic tax issues. She has worked with advisors globally to offer compatible solutions. Daksha is highly regarded in the industry, ranked as a top tax advisor in India by Legal 500, Chambers and Partners, and other prestigious publications and organizations. It's a pleasure to have you here, Daksha. So without further ado, I'll just say the session is all yours.
Good afternoon. It's a joy to be part of this marathon and discussing these changes that I am going to talk about. There could be a little bit of overlap between what was said in the previous session, because that covered all corporate taxes, and I also noticed that it covered some personal taxes and something to do with the other non-resident related, international related taxes. So there could be some overlap, but that overlap is pardonable because it just brings into focus, this session brings into focus everything that deals with either non-residents or in cross-border situation. So I would just request the audience to bear with that kind of overlap, and in case there is something that you feel that I can answer as a question, please feel free to ask. But let me just finish the presentation before we start delving into the questions, because it is possible that since I'm picking up all the non-resident related and cross-border transaction related things from all over the finance bill and budget, I could be covering what you have in mind towards in the next part of the session that is going on. So please wait for the questions and I will answer them at the end. So without much ado, let me just start with my my presentation. And I hope to find my presentation on my screen. There we are. Seems like we are there. Okay, so here we go. All right, so let's just start now. So let me just very quickly run through what it is that I'm covering. I'm obviously covering the taxation of gaming receipts, then international taxation, which impact non-resident and cross-border transactions. There is also one slide which sort of, takes note of the fact that there are certain situations which have been status quo, and within the international tax, I'm talking about anti-avoidance measures, something about startups, International Financial Services Center, rollover capital gains tax benefit, which is CAP. The reason I'm bringing this in is because even non-resident individuals, NRIs, are going to be impacted by that. Provisions which impact cross-border mergers and acquisitions. There are a lot of provisions which impact cross-border, impact mergers and acquisitions, but I'm focusing on those which impact only the cross-border mergers and
Sorry to interrupt, Daksha. I think your PPT isn't visible.
Is it visible now?
No, the screen which you have shared is just a limited one. Could you please share the desktop? Then you can go to the PPT.
Sorry, say that again. Could I watch?
Could you stop sharing once, and once you share the entire screen, as in the entire window?
Okay, that's exactly what I did now. Okay, stop share.
Now the entire screen, just click on the screen and then you can go to the...
Okay.
Yeah, now is it visible?
Is it visible now?
Yeah. Please slide up and down now once.
Okay, let me do it here.
Perfect.
Okay.
Perfect. Smooth.
Yeah, this is okay. So then I'm going to talk about higher TCS and on the LRS payments, taxation on transfer of market-linked debentures, which is the reason I'm talking about that. Are you able to see or not?
Yes, sir.
Yeah. Because the non-residents are also investing in market-linked debentures, then non-residents are made eligible to DTAA benefits for income from mutual funds, which is a positive development, lower withholding tax available for interest from business trusts to non-residents, no tax exemption to foreign news agencies, transfer pricing related. So let's delve into taxation of gaming receipts. Now, Section 194B levies tax on winnings from lottery, crossword puzzle, and game and other games, card game and other games. And Section 194BB levies tax on winnings from racing in any race course or for wagering or betting in any race course. And these winnings are taxable. This is the current position. These winnings are taxable at the rate of 30% under Section 115BB if they exceed 10,000 rupees and include winnings from, and they also include winnings from any sort of gambling or betting of any form. Now, this provision was interpreted in such a manner that each transaction, that people thought that each transaction has to exceed 10,000 rupees to become taxable. This resulted in tax leakage. So to plug this loophole, now it is proposed to amend both sections 194B and 194BB as follows. What it says is that the winnings in each case under both the sections as amended will be aggregated. Section 194B specifically excludes winnings from online gaming with effect from 1st July 23. So till then, so till 30th June 23, whatever the winnings from online gaming, which could have been covered under Section 194B, they are being taxed or they were being taxed, but now they will not be taxed under that section. Now they will be taxed under another section. And all the transactions will be aggregated to apply the threshold of 10,000 in each case. And losses will also be allowed to be deducted to determine the net taxable winnings under each section. So this is a mixed thing. Since losses are allowed, it is possible that in a year, the person doesn't really make much gain out of this and may not really be taxable in that sense under this particular section. Or since it is getting all aggregated, maybe it is much more that is going to be taxed rather than each individual winning, which was under 10,000. So it depends on each individual person who is making money out of these gaming transactions. Tax as per Section 115BB would be levied on the net winnings. The new Section 194BA would apply to online gaming winnings and would apply both to resident as well as non-resident. This is very, very important that it applies to non-resident as well. There are lots of nuances with regard to that. It is that when the non-resident is earning income out of a gaming intermediary who is situated in India, then that income is deemed to be accruing or arising in India, and therefore that non-resident is taxable. On the other hand, if the if the gaming intermediary is outside India, then whether that gaming intermediary is actually required to withhold the tax when a resident is actually earning gaming income out of this gaming activity that is being carried out. So it's become a little complex provision, since both resident and non-resident are included. And when it is a non-resident which is either subject to tax under this provision or is subject to withholding under this provision, whether a double taxation avoidance agreement would come to their rescue or not. What would be the character of this income under the double taxation avoidance agreement? First of all, whether the non-resident is eligible to double taxation avoidance agreement. Second, is this tax something which is included within the scope of the definition of tax under the DTA, applicable DTA? And if it is included therein, is there a provision which says that this particular type of income falls within a particular category, and there is a provision as to when is it considered to be arising in India and therefore taxable in India? Or if not that, does it fall under the definition of other income? In most of the treaties, other income is taxable in India as per the Indian law. In many of the treaties, it is taxable in India if the person who receives the income has either a permanent establishment in India or has a fixed base available to him, and the income is connected with that. So there would be all of those aspects which will need to be covered as soon as it is a non-resident who is involved in this particular gaming winnings, and therefore it becomes a little complex. A new proposed section 115BBJ and 194BA provide definitions for all aspects of online gaming, such as computer resource, internet, online gaming intermediary, user account. This reminds us of the definitions of e-commerce transactions under equalization levies. They are fairly detailed definitions. In some cases, they are detailed. In some cases, they are cryptic. So one would need to examine, in case of each gaming activity, whether they fall under these definitions or not, for the purposes of ascertaining whether these sections are attracted. And in case of online gaming, whenever net winning is withdrawn, the 30% tax is to be deducted, and the winnings will include both cash and the kind. And if cash is not enough to cover the tax, payer has to ensure that the tax is paid. So therefore, he may have to ask the winner to give him the cash in order to enable the payer to deposit the 30% withholding tax. If there is balance left at the end of the year in the user account, tax will need to be deducted on the same, even if not withdrawn. So there could be a situation that there will be a balance in the account, and the tax is paid, and in the following year, the person is withdrawing that gain, even before he makes any further gain. But thankfully, because the tax is withdrawn, and this way the tax deducted from in the previous year is carried forward and given credit, he will not have to be taxed again on the withdrawal. So non-resident gaming intermediary is also liable for TDS, as I just mentioned earlier. The changes in section 115BB and the new section 115BBJ are effective from 1st April 23, and but the changes in 194B and insertion of section 194BB are effective from 1st July 23. So there is a little bit of a confusion that could arise when applying the new sections and the new amendments in one part of these provisions, which becomes applicable on 1st April 23, whereas the other part becomes applicable on 1st July 23. I am hoping that it is inadvertently done and they will be aligned so that there is no confusion. The next one that I just mentioned was status quo of many provisions. There is no change in definition of residence, either of individuals or of company. And this is a huge, huge respite, because every year when there is a change in the definition of residence, it does not go down well with respect to so many people who are either non-residents, have setups outside India, have companies outside India, or companies who send people into India for taking up, becoming employees in their subsidiaries or in their joint venture, etc. All of this requires long-term planning. So having this stability, at least for this year, is a good decision that the government has taken, and we should appreciate that part. Residential status of individuals and company continues to be determined as per the provisions of Section 6 of the Income Tax Act as they existed on 31st January 23. And no change in the, I specifically mentioned 31st January 23 because the finance bill has been presented on 1st February. So at least, up to 31st of January, we are all very certain. And no change in the tax rates or surcharge for non-residents except as discussed in this presentation, which is also a good thing. Now let me move to international taxation. And as I mentioned, we will go through those headings. So first, I'm going to talk about the anti-avoidance measures. Anti-avoidance measures are there even for domestic transactions, but some of those which apply to domestic also apply to cross-border transactions. So I'm picking up those. First and foremost, of course, is the one which has already been mentioned in the previous session about not ordinary resident receiving a gift from a resident. Now, it is being clarified that it will be taxable, and for this purpose, Section 918 has been amended. Now, this is interesting because not ordinarily resident, the taxability of that person very clearly says that all Indian source income will be taxed. Only income which is earned outside India is not going to be taxed. Even the income which is earned outside India, if it is earned or realized from a business which is controlled in India or a profession which is set up in India, then it becomes taxable. So clearly, people have taken view which was a little far-fetched, because if an Indian person is making a gift, that gift does become an Indian source income. And Section 56(2)(10) does not exclude a non-resident from its ambit. So, if non-resident was not excluded, how could not ordinary resident be excluded? So it is something which was an obvious thing, which obviously people took some very sort of far-fetched views, and to ensure that litigation does not arise, this clarification is given. And therefore, if the person is receiving more than 50,000, and if that person is not receiving that from a relative, then that would be taxable. And that obviously falls under Section 56(2)(10), and therefore taxed as income from other sources. Payment by business trusts to unit holders which are doubly non-taxed, is now taxable on unit holders. So just to give you a background, business trusts mean the investment trusts, the REITs, and so therefore the income of these trusts are the pooled vehicles like an AIF, and these are given a pass-through status. But while giving the pass-through status, those provisions mentioned which are the incomes of these trusts which arise to the trust and which are to be considered to be direct income of the unit holders, of the investors. So therefore, what happened is that it is interest, dividend, or rental income, which are covered in those sections which have the pass-through status. Now, a business trust may be receiving, let's say, repayment of loan given to the SPV. That loan does not have a correct character either of interest or of dividend or of rental. Now, when that is repaid, that obviously being a capital receipt was not taxed neither in the hands of the business trust nor in the hands of the unit holders, because that specific provision was not there for it to be taxed in the hands of the unit holders. Secondly, it may be that the SPV is buying back shares that the business trust holds in the SPVs. That income is also not taxed because it is not dividend, it is distributed income. So that is not taxed in the hands of the business trust because it is not business income, nor is it taxed in the hands of the unit holders because there is no specific provision. In fact, it is exempted under section 115Q. So therefore, there is a need to deal with this situation. So therefore, new subclause 12 in section 56(2) is inserted to include as income a sum which is paid to a unit holder of a business trust which is neither interest nor dividend nor rental income. In case of units of business trust, repayment of debt could be redemption of units. This being repayment of capital, it is capital receipt, and unless specific provision to tax it is provided, it could not be taxed. Now it is provided that such amount is treated as income of the unit holder under this new subclause 12 of section 56(2)(b), 56(2), read with section 224(17)(c). The proviso says that the cost of acquiring the units will be deducted from the payment, thus excluding from the purview of tax the return of investment. And consequent changes are made in section 115UB to clarify that the sum referred to in section 56(2)(12) does not qualify to be the income which retains its character as is envisaged under section 115UB1, 2, and 3, as I mentioned, because it is neither interest nor dividend nor rental income. However, this treatment of income being treated as other income and being taxed at the higher rate is out of step with the normal provision of taxing the gains as capital gains, which is the case world over. Therefore, already it has been pointed out and a suggestion has been made to the finance minister that this should be taxed as capital gains and not as income from other sources, which is taxed at a higher rate of tax than capital. Another issue is that if the SPV has bought back its shares, the sums received by business trust would not fall in the categories listed under section 1023 FC and 1023 FCA. That is interest, dividend, or rent. If such distribution is not taxable due to section 115Q, read with section 234A, in the hands of shareholders, then when the business trust makes the payment to the unit holders, it seems incorrect to tax such income in the hands of the unit holders. If at all, such income should be taxed as capital gains under Section 46A and not as other income under Section 56(2)(12), as is proposed. Hopefully, this will be taken up and understood by the CBDT and the people who are drafting the bills, and this kind of anomaly will be removed. I agree that it needs to be taxed, but it should be taxed as it should be taxed. And if it is not taxable under the Income Tax Act, it cannot be made taxable by bringing in a non-obstante clause. And these new provisions, thankfully, are becoming applicable for the coming financial year 23-24, that is assessment year 24-25. Another thing is about startups. Now, thankfully, the sunset date to set up startup to avail the beneficial tax regime under Section 80 IAC, that is 100% tax exemption for 3 out of the first 10 years, is now extended to 31st March 24 from 31st March 23, which is a very welcome measure. We all hope that it would be extended till 31st March 2025 in view of the pandemic. There having been certain situations of the pandemic, because of which the startups could not take off as they could have otherwise taken off. But let's see how it goes. Also under Section 79(1), the carry forward of losses for set-off has been extended to 10 years in place of 7 years. And this is in line with Section 80 IAC, where the tax benefit is made available for 3 years out of 10 years. So that 10-year period is aligned now. Another is international tax-related provisions appear in International Financial Services Center. The provision was already made in the previous Finance Act, that when a fund relocates itself into the International Financial Service Center, then the capital gains arising out of that would not be taxable. And there was an exemption provided under Section 47(7)(a)(d), which exempts capital gains in case where there is a transfer of assets by an offshore fund, which of course has to be to fulfill certain prescribed conditions, or their unit holders, to a category 1, 2, or 3 alternative investment fund, which is located in International Financial Service Center. This is known as relocating of the funds. So that was already there. The sunset date for this exemption was 31st March 23, and this has been now extended by 2 years. So it is now extended to 31st March 25, which is a very welcome step, because even the relocation activities during the pandemic slowed down, and everyone who wanted to relocate could not have relocated themselves. And it is important for the government to push this International Financial Services Center if we want to achieve what we want to achieve by way of providing India as a hub for international financial services. And so therefore, this transfer will continue to be facilitated, and it will give a boost to AIFs to locate in IFSC. This would also result in transfer of units held by unit holders, as I just already mentioned, and the same is also exempt, and new sunset date will apply to that also. There is a further exemption from tax to NRI holders of ODI in relation to International Financial Services Center. And with effect, this additional exemption is available from 1st April 23 for AY 24-25. Additional tax exemption is provided to non-resident holders of overseas derivative instruments entered with an offshore banking unit of an IFSC, which fulfills prescribed conditions under Section 80 LA 1A. Such ODI holders were exempt from tax on transfer of the ODI. It is now proposed to exempt them from tax on distribution of income to them by the offshore banking unit to the extent that the distributed income is taxed in India under Section 11580 in the hands of the offshore banking unit. So the intention is not to give a double whammy, double tax deduction, but a single tax deduction. So the ODI holders will not be taxed provided the offshore banking unit is already taxed on its income from which this distribution is made. Now, this one, I do believe that in the previous session, this has already been talked about, but I'll just very quickly walk through this. Section 54 provided exemption from long-term capital gains for gains realized upon sale of residential house if such gains were used to purchase another residential house in India within 12 months prior or 2 years after the sale or construction was made of another residential house within 3 years of the sale. Currently, there is no limit on the amount of capital gains which would be exempt under this provision. And similarly, under Section 54F, though the provision is slightly different, and that in this case, it is for individual and HUF, which includes non-resident and NRI. The exemption is from capital gains tax if the individual or HUF invests the sale consideration. In Section 54, it is capital gains. In this, it is sale consideration received on sale of any long-term capital asset in a new residential house if purchased within 12 months before 2 years after sale or construction within 3 years after the sale. Now, the proposed cap is of 10 crore rupees in respect of residential house, and therefore gains more than 10 crore, even if used for new residential house, will not be taxed. Will now be taxed, sorry. The exemption of LTCG tax under 54F is also proposed to be capped at 10 crore. Even if the investment in new residential house is more than 10 crore, it will the sale consideration above 10 crore will be taxed regardless of what the cost of the new house is. Representations have already been made to remove this restriction under Section 54, not under 54F, because 54 is something where a lot of people have, let's say, ancestral properties or properties which have been inherited by them or acquired long time ago, but they are indeed residential properties, and they can't continue to hold them. They need to be sold off, even because of the fact that they have been dilapidated, etc. So in that kind of a situation, there is a genuine hardship, and that genuine hardship needs to be looked into. So representations have been made already to the finance minister. We hope that this will be taken up, and the cap will be increased, if not removed altogether. And both these changes are effective from 23-24. And since changes are prospective, if gains are realized in years before AY 23-24 and new residential property is bought in, let's say, AY 25-26, this cap should not apply. Now, as far as 54F is concerned, why no representation has been made is that the philosophy with which this government is working is that the people who are in the middle class and lower should not be taxed higher, but those for whom it doesn't make a difference if they have to pay a 20% tax or not, when the value, the gains that they realize in hundreds of crores, they should not be given this kind of a tax holiday, because then that impacts the revenue. Not only that, it is not a huge part of the population which is getting impacted by that. So that is something which I think we all can live with. Now I'm going to talk about provisions which impact cross-border mergers and acquisitions. Expanding applicability of angel tax to non-residents to achieve the objective of prevention, generation, and circulation of unaccounted money through share premium. This section, which was restricted to receipt of money from residents, is now expanded to cover non-residents. This change becomes effective from AY 24-25, and receipt of premium from VCs, VCFs continues to be outside the purview of this tax, and also premium received from persons which are notified by the central government continue to be exempt. There is no change in how the fair market value is to be determined. Higher of Rule 11U and 11UA, or based on the value of assets including intangibles such as goodwill, know-how, patents, copyrights, trademarks, licenses, franchise, or any other business or commercial rights of similar nature is to be adopted. Now, it is interesting that already these intangibles are now going to be taxed in the hands of the seller if that person is receiving consideration for intangibles. We will be looking at it in a minute, but that is something which is interesting. So if those are already taken into consideration for the purposes of valuation, then there are certain interesting issues which arise, which I'll talk about in a minute. But the question that arises is whether customer databases, employee skill sets, etc., can be part of these assets, since for the purposes of valuation at least, since in practice, many a times the high premium which an investor is prepared to pay is because of the high value that they place on these intangibles of such companies. So that is a question that arises, because these are not some things which are already mentioned in the valuation rules. So whether they can be included to arrive at the higher of those two valuations is something, or will it be covered in the DCF valuation method? So that's something which will need to be considered on a practical level, depending on a case, on the facts of each case. So a consideration which is paid to a target, or this is something that I just talked about, paid to its promoters or shareholders for non-compete or intangibles will now be taxed. This is an interesting thing, because every one of you who has been involved in mergers and acquisitions know that considerations are paid for non-compete, and there is a patina of litigation on that, whether that non-compete is that payment is under 28.4, or is it capital receipt, or what it is, and that interpretation issue has been there. So there is a huge amount of litigation which has been going on this. So consideration paid in a mergers and acquisition for acquisition of intangibles was not considered taxable, since the law did not provide the mechanism to compute capital gains, and there was no provision to determine cost of acquisition. There have been significant litigation in this regard. It is now proposed that from AY 24-25, Section 55(1)(b) would be amended to include a new form of asset of any other intangible asset, or a payment for non-compete to give up any other right. So now it is very clear that the non-compete payment now it is, here is an acceptance that this is a capital asset. There has been litigation, whether it is falling under 28.4 or it is a capital receipt. Now, by saying that payment for non-compete to give up any other right is a capital asset, and it seems to support the arguments made in the past that it was actually a capital receipt. And of course, Supreme Court's decision in Srinivasa Shetty was always used to say that something for which no cost of acquisition is available or no mechanism is provided how to compute the cost of acquisition, then it is clear that the legislature did not intend it to be taxed, and therefore it was not to be taxed. Of course, as I said, on non-compete payment, there was also always an argument that it is not a capital receipt because it falls under 28.4. But now it is clear that it is a capital receipt, and its cost of acquisition is going to be regarded as nil. The entire amount which is paid will become capital gain and taxed accordingly. Similarly, cost of improvement for such asset is also prescribed to be nil. Now, where the intangible asset is an acquired one, the cost of acquisition will be the price paid on its acquisition. Now, there are several questions which arise in a situation like this. First of all, is it possible to value intangible and bring that into the balance sheet and claim such valuation as the cost of acquisition? A better view will be, a non-litigious view will be not to do that, but because no revaluation or valuation of asset for which there is no substantiation of showing the cost is accepted as being the cost of acquisition of that asset. So the answer to that could very well be a no. But then let's go into the second question. Or is it possible for someone to demonstrate how the cost of this intangible asset, depending on the type of intangible that it is created? They accumulate all costs incurred for creating the intangible, the way it is done for plant and machinery or any other type of asset which is built over a period of time, and use that as cost of acquisition. There is a case to say that it should be permitted, but there is no knowing that it would be permitted, and it is likely to be litigious. In case of intangibles which are acquired, is it necessary that the cost of improvement should be nil when it is possible to ascertain the exact cost? Because since you have acquired the intangible, it is already existing in your balance sheet, in your books. Then if you are adding something to it, how fair is it to say that that improvement should be, the cost of that improvement should be nil? So there is a case to say that for that, the cost should be, the exact cost should be given as cost and not be shown as nil. So let's see whether this position is accepted while passing the finance bill. Then the other question that arises is, the law is silent on whether such gain will be long-term or short-term. Where the intangible asset as defined above is an acquired property under a merger and acquisition transaction, it should be possible to ascertain whether the gain is long-term or short-term based on what it was acquired when it was acquired. Where it is self-generated, there is no guidance. A clarification in this regard would avoid any litigation. This and the other three questions, as I mentioned, are definitely need some clarification.
Ma'am, sorry to interrupt, but we might have to wrap up in next 4-5 minutes because we are going over time.
Yes, I did start 5 minutes late. So anyway, I have only 2 more slides, so it should be possible to move quickly. There is a hike in TCS on payment under LRS. This was also covered. Now, the only thing is, it seems rather unfair to, even without giving any reason whatsoever, there is a 4-fold hike on the payment under LRS, and there is no threshold. A single penny which is paid out is going to be taxed at 20%. It's a significant concern when a person is becoming non-resident, or when a person is setting up business outside India. They do need to spend a lot of money and need to take money out, and having to pay this kind of tax is really unfortunate. Higher tax on sale of market-linked debentures. I will go quickly on this. The market-linked debentures are now being equated to derivatives, because they derive their value to the performance of the underlying securities in the market, and hence should be taxed as income from derivatives. Income from NRs are now made eligible to DTAA benefits for income from mutual funds. This is a good relief for non-resident mutual fund holders, and of course they have to provide the tax residency certificate. But bringing this provision into the section itself makes it much more easier for the mutual funds to apply the DTAA rates. Lower withholding tax certificate is now available to the business trusts when they are making payments to non-residents, which interest qualifies under Section 194 LBA. This section was missing from the list of sections which are eligible to approach the tax officer for a lower withholding tax under 197(1). So this is a good insertion which has been made, and it will reduce a lot of difficulties that the non-residents were facing. The payers were facing. No tax exemption to foreign news agencies. Many would know that foreign news agencies which collected news from India were exempt from taxation in India. It is now that exemption has been removed, and depending on whether that news agency has a permanent establishment or a business connection, or if the character of income is something like royalty or anything else, then it will be taxed as per the provisions of law under the Income Tax Act or the DTAA, which is applicable to them. Last but not the least, there is a reduction of time in furnishing response to notice under transfer pricing. It has been reduced from 30 days to 10 days. Can't understand the reason, because it is again extendable, but there we are. That's what it is. And that brings me to the close of my session. Thank you.
Thank you so much, ma'am. Can I have one query, which is from one of our attendees?
Yes, please go ahead.
Yeah. So is it correct to comment that the confusion continues vis-a-vis applicability of SEP provisions beyond digital transactions, specifically whether it covers all sales of goods and services and cross-border transactions?
Sorry, which provision?
Continues applicability of SEP provisions beyond digital transactions.
SEP?
Yeah.
I use it as a significant economic presence.
Correct.
So just say that question again. I didn't get the question.
Is it correct to comment that the confusion continues vis-a-vis applicability of significant economic presence provisions beyond digital transactions, specifically whether it covers all sales of goods and services and cross-border transactions?
Okay. So yes, the confusion remains in as much as where there is no where the transaction is connected with a business connection or permanent establishment, the business income will be taxed in India. to the extent that it is allocable to the SEP or the business connection. Having said that, the SEP is applicable only in respect of those cross-border transactions where the non-resident does not come from a treaty jurisdiction, and the treaty does not apply to that non-resident. If treaty applies, then SEP has no meaning because it does not appear, does not figure in a DTAA. Now, the thing is, when those transactions are not taxable under permanent establishment, they could well be taxable under equalization levy, which is outside the Income Tax Act. So if they are going to be taxed under equalization levy, will they also be taxed under SEP if the non-resident is coming from a non-treaty jurisdiction or the treaty does not apply to that non-resident? Currently, that confusion remains. It was hoped that in this budget, at least, some roadmap would be given to say how the government is going to deal with both Pillar 1 and Pillar 2 when they come into effect, so that there is no overlapping, and whether the government is going to go ahead with still continuing with equalization levy in respect of those multinational organizations which do not fall under Pillar 1 because of the high threshold of turnover that is applicable for Pillar 1 to apply. So yes, the confusion still remains. There is no clarity there. But as I said, that confusion is limited to those non-resident entities or individuals who are not eligible to treaty benefits.
Fair enough. Great, ma'am. Thanks a lot. It was a pleasure having you with us for this marathon.
Thank you.
Thank you so much. Thank you.